Hello everyone, we are back with another video in our Starting Up a Business from Scratch series. Today we're talking about business structures and capital gains, or capital losses maybe. So Kingsley, talk to us about how this works. Now, just before we start on that, I do just want to let you all know this is general advice only in nature. For more specific personalised advice, you will need to speak to Kingsley or an accountant.
Thanks, and that's quite true. In fact, interestingly, possibly in a sense, possibly the loss side is where it gets very complex, and you do need some additional help and advice. And there is lots of tiny little differences in people's circumstances that can lead to very dramatic outcomes. So if Bob down the pub saying, "Oh, this is what I did, this is how to work for you," do not rely on that. There's one small difference, and it could be very, very different for you. But to get into it, let's start again with our sole trader, our simplest structure. On the capital gains and capital loss side, I guess it is simple, and you might even say pretty effective, actually, in that if your business has gone really, really well, then you are going to get people might probably already be aware of the general discount of, I've owned an asset for 12 months or more, and I've sold it for a capital gain, then I can cut off half the gain and only pay tax on it. So to take a non-small business example, let's say we've bought some shares for $10,000. A couple of years later, we've sold it for $20,000. We've made a $10,000 capital gain. We would only have to pay tax on half that, on the $5,000. So sole traders will get that on selling their business. There's also a piece of tax law that is very relevant to small business people, where you can get exemptions for selling small businesses just for small businesses. Key things to look at there is to get it, and again, there can be some enormous complexity around this, so you will need to consult on your specific situation. But broadly speaking, if your business has got sales under 2 million or your net worth is under 6 million, you can probably get these, but you need to check, and you need to check before you've sold your business, or you might find it's too late. But if you do get them, then you can get at least another exemption again, an active asset one. So if we've sold our small business, and particularly goodwill is a classic example. Let's say there's a very large amount of goodwill in this sale, $500,000. We own the business more than 12 months, so we get the first general discount everyone gets, down to $250. Goodwill's an active asset of your business, what's known as an active asset. You get to chop that in half again, down to $125,000. And then you've got other things up your sleeve of, you might be able to, if you want to go back into business, you can roll that gain into the next business and not pay any tax on it, or you might want to put that money into super, and you can put up to $500,000 each person into super. And so you can possibly sell your business for some millions as a sole trader and literally pay no capital gains tax at all. So that's pretty good. On the loss side, I guess it's simple, and the loss is in your name. It's for you, and you can carry that forward as long as it takes until you have a capital gain on something else. Possibly the point to make about capital losses generally across all structures is that you can only claim capital losses against capital gains. So if you sold your small business and you sold it for a capital loss in year one, and then you've got yourself a highly paid job in year two, unfortunately, you can't claim that capital loss against your high paid salary. You would have to wait till you make a capital gain of some sort, and you could claim it against that. And that could be many years away. So just bear that in mind. So that's sole traders. Partnerships being the next one. Very similar story, and partnerships again, I suppose as much as they're not good on risk, on capital gains, in actual fact, I guess you would say they're actually pretty good. They get all the exemptions we just talked about with sole traders, so they get the 12-month one, they potentially get the small business one, like the active asset, being able to put it into super, providing you pass those tests. So again, you could sell a partnership for a capital gain, possibly in the millions, and literally pay no capital gains tax at all. Losses are good, and in fact, if we were amiss in something we said in the previous talk on the tax side, is you can split the losses out in a partnership, and carry them forward. And as you can with a trading loss, which we didn't talk about in the previous video, that you can allocate losses out. Other structures can't do that. So that's pretty good in a sense. You can get the loss, even though you've run a business collectively, we can get the loss down into, let's say, Kingsley's tax return and Louise's tax return. We don't require that partnership to go and make a capital gain in the future. Kingsley and Louise could possibly make their own capital gains and use those losses. So that's possibly quite handy. And that's partnerships in a abbreviated nutshell. Companies, unfortunately, this is their weak point. This is where they don't necessarily compare that well to the other structures, and they don't even get that general discount. So where we've talked about, you own the shares, sold for 20,000. If you bought those shares in a company and own those shares from 12 months, tough luck. You're going to get, depending on whether you're a big company, little company, either going to get taxed at 25% or 30%. The logic there being, well, that rate's pretty low already. So, it doesn't need to be discounted further is sort of the logic. You may or may not agree with that, but that's the logic. And certainly at the 25% level in a small business company, if the gain's of any size, well, that's sort of on pace, because if it's a big gain in a person's name, when you think about it, 47, but you chop that in half, that's 23 and a half, whatever it is, versus 25. There's not a lot in it. So to some degree, you may not be, if the capital gain's big and you would have been pushed into the top brackets anyway, you're probably not that upset. But on the flip side, it can also be very complicated in getting those other small business exemptions. And what you've got to watch there is, it may well be your company does qualify for me, so it's an active asset, I can halve it again and so forth. But if the company doesn't pay tax on it, then when they pay the dividend out to you, there is no stored credit. So it's gone into your tax return and you get taxed at your normal rate, which might be 47. So that's not great. There's some things you can do possibly with liquidating a company, and if you sell the shares, you might get a better outcome and so forth. But generally speaking, companies are not that great for capital gains. And so you do need to bear that in mind. If you're going to set up a business that you think you might be able to sell down the track for a handsome capital gain and goodwill, company may not be the right structure for you. The flip side is the classic example where you'll see people will do it anyway on setups is tradies. They will set up in companies almost always, because unless you grow that business enormously, generally, if you're a bricklayer, when you decide to get out, you just got to shut your business down. You won't sell it to someone. Any goodwill walks out the door when you walk out the door. So they don't necessarily have to worry about capital gains. So they are quite keen to go with companies. Next options are your trusts. And again, they are very good on capital gains, particularly the discretionary trusts. They will get all those exemptions. The big qualifier here, though, is the tax law to make sure they qualify is extraordinarily complex. And a lot of it hinges on how you've been allocating the profits in the prior years. So it is critical that you are talking to your accountant before you sell your business. And even there, I'd go further to say, you need to be talking to your accountant when you're first thinking about selling your business, because it might be affected by what you did with your profits the year before or something, that you don't get the exemption. So if you go to your accountant the day before you sell your business and you're in a trust, that might be too late. You need to give them fair warning that you start to think about doing that. And then they should be able to ensure that you get all these exemptions we are talking about. And again, possibly selling a business for a capital gain in the millions and literally paying no capital gains tax. So they get them, they're excellent, but it's complex. And you must get advice well in advance of you actually selling it. If you sold it on Monday and you've been to see your accountant on Tuesday, I'm sorry, but you've just done something very, very dumb, if you're in a trust particularly. Unit trusts have a little bit more in common with companies, but they do, because you've got a fixed sort of interest in it. So that could possibly come down to, depending on how you're doing this, what you sold your units for, and you would get your 50% discount. And if it's a small business, possibly also the other exemptions. If it's sort of being fed through, it can get a bit complex there, and it can sort of eat up your cost base of what you paid for your units. But again, you'd say unit trusts are still pretty good on capital gains tax. Not probably quite as good as discretionary trusts and partnerships and sole traders, but pretty good, and might well be a good way to own a business that you think is going to go up in value.
So, you know, we're talking about potentially selling business and capital gains here. And the reason we're doing this, guys, it comes back to what we talked about in the risk, is that it's really important to plan for the worst and plan for your business when you're starting it up, so that you are prepared and in the right structure from the start, or at least know when to have those conversations with your accountant about when to change, ensuring that you are actually doing what is right for your business situation.
Yes, and actually, Lou, before we final, I guess I've been a little bit amiss there in terms of the losses. All three of the last good ones, well, companies are a bit not so hot on capital gains. Companies, family trusts, and unit trusts on losses, on capital losses, all have the problem that the losses are trapped in them. So if a company has a loss, a capital loss, you'll have to wait for the company to make a capital gain. The discretionary trust has a capital loss, you'll have to wait till the trust makes a capital gain. We can't distribute it out to the people. And the same again with the unit trust. If it makes a loss, you're going to have to wait till the trust itself makes a capital gain before you can use it.
So, guys, this is what we're talking about, is getting it set up from the start right, or at least knowing how to change when the time is right. So thank you very much, Kingsley.
Thanks, Lou.